Everybody, welcome to the morning market briefing. It's Thursday, April 21st, 2022. Hope you're doing well. Tom, how's it going, man?
Do well. Missing Ben this morning.
Yeah, I don't know if missing is the right word, but we are without him for sure.
I was missing him when I was putting the agenda together this morning.
To
make sure we had something to talk about.
When Ben puts things together, he usually gives us a lot of detail. I know on mine, I had like an entire 2 topics that I just put bullet point Tom, put people to sleep. So we're going to do some of that, but we're going to open up with initial jobless claims coming out right now. Tom's loading up the Bloomberg terminal so we can get the number. The expectation is for 180,000 new jobless claims last week. We came in at 185,000. Tom, I think this data point's getting a little bit lost in the shuffle. It's probably not the best read through on the state of the economy. But still an interesting data point as we try to build the mosaic of what's actually going on. Where'd we come in?
So the expectation was 180,000. We came in at 184,000. So pretty much in line. In terms of revisions, last month we had 185,000. They revised that up to 186,000. So everything's pretty much in line. The real number to take a look at, though, is the continuing claims actually dropped quite a bit. So last month, continuing claims was 1.475 million. The survey estimate for today was 1.459, but we actually came in at 1.417. So we're definitely seeing a drop in continuing claims, which is good. It means people are leaving the unemployed realm and taking jobs. So that's a net positive number. But I mean, it's the differences between the expectations and reality were so small that I don't expect it to move markets at all today.
Yeah, I think we were talking with a client yesterday about the genesis of the morning calls that we started doing back in 2020. I mean, there was a period where the initial jobless claim number was incredibly important as we were trying to understand just the impact. It's still a data point that, as I said earlier, I think it's worth mentioning. I think I would start to have concern if we had a massive miss. Expectation was 180. We came in at 300,000. I don't know that this is necessarily going to be a needle mover, especially given everything else that's going on kind of in the economic backdrop.
Yeah, I think it's going to be a much more important number, especially if we start to see a very aggressive Fed. They basically said, we're going to, in the Sophie's choice of the jobs market versus inflation, they're choosing to kill the jobs market in order to draw down inflation. And so once they get really aggressive, I think that might start to be an indicator. But for right now, we'll get into what they talked about in the Beige Book yesterday. It seems that the jobs market is pretty bulletproof right now and probably has quite a bit of hardiness and robustness going forward. And it's probably going to take a lot to move that.
Yeah, if anything on the Beige Book commentary, which is a great segue there, like a true pro right there, Tom. If anything, the challenge people are facing are people leaving, but leaving for other jobs that pay more money. Quote, many firms reported significant turnover as workers left for higher wages and more flexible jobs. So we're continuing to see a competitive labor market. I think right now, if you said, how would you define the labor market? I would name a number of factors before I got to, well, there's too much unemployment. People can't find jobs. I think the biggest concern, so we've seen this with economic surveys at a high level. We've also seen it even just in talking with clients, doing some internal surveys, things like that. The biggest thing I think people are facing really is quality of work, cost of work, things like that. Not so much, we don't need workers. We can't find workers. I think they're a little bit more nuanced points there. What the Beige Book have to say about inflation, which I think obviously remains the number one topic.
Yeah, the concerning thing is that, so they put this out 8 times a year. So it's roughly every 90 days. And the read through right now is that
don't do the math on that.
Yeah. We're roughly doing
every 45 days, maybe
45 days. Is it 45 days or is it 90 days?
If they do it 8 times a year,
it's 45 days. Yeah. Well, I don't do math. This is a Ben thing.
There are not 720 days in the year.
That's a great point. I was thinking every month and a half, right? Because 1.5 months. Yeah, I'm an idiot.
Still not 90 days, but go on.
It comes out every once in a while. Let's go with that. And we like to look at it when it comes out. But it's basically anecdotal evidence from, the different regions and districts within the Fed, and they kind of come up with a picture of what the economy is doing. And the good news is they said the economy expanded at a moderate pace over the last 45 days. The consumer spending continues to be strong. They're seeing a lot of real beneficial the farmers doing well from rising crop prices. They're managing to push that through and make nice profits. The downside is that they're not seeing really any indicators that inflation is falling in any way. So they say, quote, firms see inflationary pressures that remain strong since the last report, with firms continuing to pass swiftly rising input costs through to customers in most districts, and are expecting inflationary pressures to continue over the coming months. So they're basically saying we may not have hit in peak inflation, which was, sort of our thesis going forward. And, this is backward looking. And so it's possible that maybe we perhaps did, and we did hit peak inflation. The next Beige Book is going to indicate otherwise, but that's really not what the Fed is seeing. So good news is consumer is strong. Pricing power for companies is strong. The economy is expanding. Bad news is inflation seems to be pretty sticky at this point. And so they're definitely going to have to be a little bit more aggressive, I think, in order to satisfy that.
Yeah, I think it's going to be continue to be the issue that is at the forefront of discussions, and it has implications even in the job market, as we touched on earlier. Certainly has implications, as we will speak on it in a moment, on earnings. But in the meantime, we had a very, very strong 20-year auction yesterday. 20-year notes. Tom, talk to us about when we are looking at kind of the relative strength of a bond auction. What's the read through, and what did we see yesterday?
So the real strength is what they would call bid to cover. So that's how many dollars are bid for versus how many dollars are up for grabs. So there's $16 billion of notes, and we got a 2.8 bid to cover, which means there's almost $3 worth of bids for every dollar that was out there. So we're looking at, call it, here we go, tough math, but roughly about $40 billion, let's say, in $45 billion in bids for $16 billion. Yeah, we'll call it 40 to 50 billion dollars in bids for $16 billion in 20-year notes. And so that means there are a lot of people who are clamoring to get these bonds, and most people are going home with empty hands, which is a sign of strength. That's, a lot of people saying, hey, 310 yield, came in at 3.095 was the when issued yield. So 310 yield on a 20-year bond seems like a really good deal. And historically speaking, that's about as good a yield as you've seen. I can't remember the last time. Well, first of all, we didn't have 20-year bonds. They started issuing them in May of 2020, but this is the highest bid to cover since they started issuing the 20s. It's definitely the highest yield by far that we've seen. And so there was a lot of demand there. People are saying, hey, I feel very comfortable locking in, making 3.1% for the next 20 years in perpetuity. That's a pretty good yield, especially when you look back at when they originally were issued. I think they were issued at like 108. So you're getting 3x roughly what you were getting, in May of 2020 when these bonds were issued. So you're making a lot more money than people who took a swing at the original 20-year bonds.
Yeah, I think the bid to cover thing is interesting. It's an auction. It's no different than if, you were wanting to buy something on eBay. It might be a really obscure item, and it's hard to figure out what it's actually worth. You look at historical prices and you realize, hey, like only one of these things is sold in the last 12 months. But if you look for something more popular, sometimes you look at it and you're like, hey, 15 of these is sold, and there's been 100 plus bids on each one of these. You get a pretty good read on what the market is looking at. So it's not only that, these priced where they priced, but there was high demand, which is worth interpreting. Were you surprised in terms of kind of that strength? We saw some flattening between the 2 and the 10-year. Are you surprised by that?
I don't think so. I think that people are worried more about the next 5 years. And I think that's what the move on the yield curve indicates. And people are worried that the Fed's going to get really aggressive on the short end. And so we saw the short end sell off. And then we saw people just saying, hey, I'm ready to take this money and lock in for 20 years and guarantee myself 3%. And so there's a lot of strength on the long end. So that's functionally what happened. Is they're worried about the short term, worried about short-term bonds, don't want to get locked in anything if rates are going to go significantly higher for the short term, but they do want to lock in an excellent yield for the long term. And so that's really the move we saw. It makes sense to me. I think there's a lot of opportunity in bond land, and I don't know how long it's going to be there. So we need to make sure that we're buying good bonds, clean bonds, and hoping that, even if rates go higher, anything that comes off the board, is going to have a lower yield than what we're buying. And even if it goes higher, that means the next round of bonds that come off the board are going to get even better when we replace them. And so, we just kind of have to navigate this bond storm as effectively as it can. But I mean, it's just the longest, most sustained, and most aggressive sell-off in bonds that I've seen in my career. And it's been a very short period of time that we've seen such very strong moves.
Yeah. We will hear more from the Fed today. Powell is having a summit with Christine Lagarde and others. Tom, if you were wanting to give the cliff notes of what people should be looking for, obviously inflation is on the list of things, rate hikes associated with that. They're going to address those things in some way, shape, or form. But what are you looking to hear? Is there anything you think that could signal change in policy?
Yeah, so it's kind of split up between the different central bank heads. So we've got Jay Powell, who's the US, Christine Lagarde, who's the ECB, and then you've got the Bank of England, who's Andrew Bailey. They're all going to be talking about their interest rate policy going forward. And so the first and foremost is seeing what Christine Lagarde says, because she has been kind of all over the map in terms of her signaling. Initially, it was like, we're going to see great growth. Inflation is going to fall. We don't really need to be aggressive. And then, 2 weeks later, she switched that tune pretty quickly. So the big indicator is going to be if she suddenly gets very hawkish and says, hey, we're wrapping up our taper and we're going to lift off immediately. That would be an indicator. I think that's going to be really rough on rates. But I think that she's moving that way. I think she's just trying to do it in a little bit of a piecemeal fashion, which is, every couple of weeks, she's getting a little more hawkish. And so if we see a significant change there, I think it's going to be very impactful. In terms of rate hikes, we're looking for Powell to say something to the tune of Jim Bullard, saying that we might get a triple rate hike in May. That's something we definitely need to be on the lookout for. And then Andrew Bailey as well, they're looking for any sort of information on what the Bank of England is going to do. Right now, there's some back and forth between whether or not they're going to raise one time or two times. And so any sort of read through we can get from him will probably be an indicator that we can read through on the US as well. So Bailey says, Bank of England's raising twice, that pretty much guarantees that we're going to be raising twice, and futures indicate that. But if he says they may get more aggressive, then it's perhaps possible that Powell's going to do the same. So they all move in concert. It's a little bit more of an easier read through than if, Lagarde says, hey, we're getting super dovish. Powell says we're going to be a medium dovish. And then, Bailey says we're going full hawk. Like, that would be confusing to the markets, I think, and cause a lot of volatility. But if they're all on the same page, at least you can kind of forecast which direction we're going. And then, of course, like everything that's important right now in the economy, you want to see everything each one of them says about inflation, what they see in their forecast. Are they changing their tune that the second half is going to wrap up with lower inflation? Are they beginning to, kind of have that come to Jesus moment where they know that inflation's really sticky as well, and they're going to indicate that, or if they're going to continue to say, hey, it's going to fall in the back half, and, you've got to kind of adjust for that accordingly. So any sort of read through we can get from that is going to be important as well.
Awesome. Lots to talk about on earnings. We're going to really focus on some automobile related companies, although we got earnings kind of late breaking in from Blackstone. We said that was one to kind of potentially keep an eye on as we talk about market volatility and some of their alternative investment strategies. Blackstone up about 5.5%. Pre-market was up close to 6% a little bit earlier. Beat expectations. Profit fell a little bit relative to where it was previous quarter, but that being said, seems to be executing pretty well. We'll break that down maybe a little bit more on tomorrow's call, but just wanted to mention that briefly because I know on Monday I said that was something I was interested to keep an eye on. I think the biggest story on the earnings side from yesterday, other than the continued fallout for Netflix, which closed down 35% and is down another 5% pre-market today. Tesla, very strong earnings, up 7.6%. What was most interesting to me is just some of the commentary tied there too. Margins are exceptionally strong. Something that has not necessarily been the traditional profile for Tesla, may potentially speak to just the advantage they have of manufacturing in-house and gaining scale and operational efficiency there. The other thing that was really interesting was just the Super Bowl effect. Tesla famously does not have an advertising budget. They don't spend money. If you look back at the Super Bowl, if you recall, there were just tons and tons of commercials for electric vehicles. That tide lifted Tesla's ship tremendously. They actually had a chart in their presentation demonstrating the sales orders by day, and the day after the Super Bowl was a significant spike relative to where they had been throughout the quarter, and not to say the rest of the quarter was poor. But kind of interesting. I mean, when you think about it psychologically, it does makes sense. If you get inundated, with a type of product over and over and over again, you're kind of on the fence. You may or may not buy that single brand or one of the brands you heard, but you may say, well, who's the biggest player in this space? And for now, Tesla remains the most prominent player in the electric vehicle world. So they really benefited from that. Tom, I kind of felt like this was going to be a good quarter for Tesla. A little bit surprised in some regards to see that they're not up more. They're up about 7% pre-market. We're starting to get upgrades. Do you think this is a good sign for the quarter ahead, or do you think the market's still a little bit in wait and see mode?
I think it's really impressive. I think the operation efficiency that we saw from Tesla was just unbelievable. And Elon Musk continues to be an unbelievable operator. And I mean, the valuation doesn't make sense. They just don't make enough money to garner the dollar price that they have. But I think that they're coming around operationally to figuring that out, and maybe perhaps raising the evaluation to where the price is, I think is really where we're going. But I mean, they were down, I think 5.5% yesterday. So being up 7.6, they're basically a little bit over where they started the day yesterday. So I think that the market, in my mind, and we'll talk about Carvana and to Netflix sort of piggybacking on that, it feels like the market is more ready to punish companies for bad earnings than they are ready to celebrate companies for good earnings. And I think that's what we're seeing here is that, if Tesla had missed even a little bit, I wouldn't be shocked if it was down double digits, but because they beat in a pretty impressive manner, they're up a little bit compared to where they were yesterday. And I think that, if you look at Netflix missed and they just got absolutely hammered. And I think that that's what the market feels like doing right now. And so, I think it's a good opportunity to kind of keep an eye on Tesla. I think we need to do some more legwork on it and really try and figure out what the valuation really is and look for opportunities there if we can. But they continue to be impressive, really impressive company. It used to be, I feel it's almost like a self-fulfilling prophecy with Tesla. It was, at first they had no fundamentals and almost no cars. And now they have some cars, and the fundamentals I think are falling behind now.
Yeah, I think it's interesting. I think the sentiment you have in terms of the market rewarding companies and punishing others, I think the scale of it's right. I mean, it feels like right now, if you come out and have a solid quarter operationally, beat on revenue, beat on expectation, reiterate or raise guidance for the full year, the market's kind of giving you a little pat on the back. If you come out and you miss, they're pushing you off a cliff. And we see that in some regards. We won't go into great detail just because these are companies that I don't know that anybody really cares all that much about. But Carvana, down 9%, lots of missteps. On the other side of the table, you have AutoNation also playing heavily in the used car market. A quarter ago, they beat on expectations, and they really attributed it to the strength in demand on used vehicles. But AutoNation beat earnings expectations by more than 10%. I mean, it was a huge beat. They're up 1.69%. So there's definitely some disjointedness in terms of how much the market is willing to reward versus punish right now. Anything stand out on those two?
I mean, I think it's interesting that AutoNation basically said, we saw unbelievable used car demand. They didn't have any problems with their supply chain, versus Carvana. They listed pretty much every single excuse in the book. They had, they said falling used car prices, rising interest rates, declining appetite for their debt, I guess, is causing them problems. They're saying that fuel prices are driving fewer people buying cars from Carvana. I think it's just, they don't really know what's going on. I think they're just executing poorly, and so they're down, almost 10%. I think they were down as high as 25% last night, after they announced earnings, and it's come back quite a bit since then. But it's just the market is just basically a DUI checkpoint right now. It's either you get to continue on going the way you were going, or you go to jail. And I think that's, basically the story we're getting here, which is that,
or you got to know again.
Yeah. AutoNation, they blew, and they were not drunk. Carvana blew, they were drunk, and now they're going to jail in market terms.
Not that we're saying they shouldn't go to jail. It is what it is. Lost in all that. I mean, we've talked a lot about the big blowups this week, whether it's Carvana, whether it's Netflix. Market looking pretty strong today right now on the futures basis. A lot of that, I think, being driven in no small part by earnings. We are seeing a number of companies really execute. And although they may not be, getting trophies for that, they're pushing the market up. Dow futures up 65 basis points, S&P futures up 84 basis points. NASDAQ futures up 116, so a little more than 1%. So looking relatively favorable, which I think is always an encouraging sign in the midst of the busy part of our earnings season. When you see lots of data coming through in terms of how actual companies are operating, not anecdotally, but on their actual P&Ls, I think it's a very good to see that support market expansion. And that's, at least for today, kind of what we're seeing. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day, and we will talk to you soon.